Hey, what's up guys? In this video we're going to be going over basic terminology. I'm going to go into more detail about a couple of the things that I'm talking about in this video, but this video is just to introduce you to the basic terminology for foreign exchange trading or Forex trading. So that way you know the basics and you're not completely lost whenever I'm going over how to use the platforms and stuff. You at least have a little bit of an idea. Then after you learn how to use the platforms, I'm going to go into more detail about a couple of the things. So I'm going to swipe over here. This right here is the stuff that you're going to be seeing there in your course below this video. And I'm just going to go through each one of these step by step, and we're going to cover them briefly but significantly enough to where you have a basic understanding of what it is, okay? So the Forex basics and terminology. The first thing we have right here is Forex. Forex means foreign exchange. It's a shortened form of the word foreign exchange. And whenever you do Forex trading, you are foreign exchange trading. You can even go as far as to call it foreign exchange currency trading. But what you're looking at right here, for instance, the euro versus the US dollar, this right here is called a currency pair. We're going to learn about that in a second. But you're essentially trading the value of these two currencies. So the euro versus the US dollar, you're trading based off this exchange rate right here, and you're trying to make a profit off of buying the market before the exchange rate increases or selling the market before the exchange rate decreases to profit off of it. Either one of those two ways. So that's it. Forex means foreign exchange in short. So the second thing, accounts. There's a live and a demo account. Two account types, live and demo. Whenever you're trading a live account, it's going to be real money that you put on the line. So whenever you're trading, it's going to be real money that you either make or lose. Before that, months before that, you're going to be trading on what's called a demo account. Demo, of course, is short for demonstration. It is a demonstration account with play money, fake money. I'm going to show you how to set that up in the video on how to use MetaTrader 4 on your phone. And you're just going to be trading with money that's on the house. It's just fake. It's not real, and it's 100% to get you started and get you learning and experienced and practicing. So that way, whenever it comes time for you to actually trade real money, you have a basis of understanding for how to use the app and how to trade and how to analyze charts and stuff. So you're going to be starting with the demo account, and then after you become consistent and profitable and you're doing well on a demo account for a few months, a few weeks to a few months, then you're going to be able to switch over to a live account, and then that's going to be something that we help you get set up here in this course. And the live account, you'll be able to put money into your live account, trade it, and then withdraw your profits. So that's how it works, live and demo accounts. So the next component is looking at the main chart. So whenever you're looking at Forex, you're going to have what's called the main chart. The main chart is just very simply the chart you look at when you're trading. Whenever you're trading, you're going to trade these things up here called currency pairs. You're looking at this main chart, and whenever someone says, hey man, if you guys look at the euro versus the US dollar chart, they're just referring to the main chart. So this right here on your screen, there's also a screen on your phone where you can look at charts. The main chart is just literally the price chart of what price is doing. So the next portion is currency pairs, and we're going to go over abbreviations as well. Currency pairs, like I've touched on, it's this right here. So there's a couple different currency pairs. I'm going to drag this out so you guys can see it a little bit better. As you can see, we have this Euro USD, GBP USD, GBP JPY. We have these right here, and these five little things that you can click on. These are all called currency pairs, and for each currency pair, it has its its respective chart for what price is doing. So, for instance, if we're just looking at this in a real simple way, this price chart right here shows us the exchange rate of the euro versus the US dollar, and it starts with these base currencies. And then how it works is, so for instance, 1 euro, I'm sorry, 1 euro equals 1.14 US dollars. So that's how the exchange rate works. Same thing with GBP USD. 1 Great Britain pound is equal to, right now, 1.28 US dollars. And it's just that simple. These are the currency pairs that we trade in Forex. They're just called currency pairs, and you trade them, and you can make profit based off the exchange rate going up or down. So that is currency pairs. And the abbreviations, just real quick. For instance, if we're saying like, hey guys, I'm looking at Euro USD, I'm looking to buy here in a bit or whatever. Oftentimes what we'll do is, you'll see this a lot in the chat, is people will do something like this. They'll call it EU just to save time. So for instance, EU, people will say Euro US dollars EU. GBP JPY, an abbreviation for that is literally we just take the first two letters. So GBP JPY would be GJ, and you can do this with any currency pair. GBP USD is GU, USD JPY is UJ. So whenever you see like these just two little letters together like that, it usually means someone is referring to currency pairs. And whenever you start trading, there's 26 currency pairs you can trade, and there's more if you consider commodities and futures and stuff like that. But whenever you're trading, just to keep things simple, I recommend only picking two currency pairs. And the two currency pairs I recommend you start learning on is Euro USD, which is the most commonly traded currency pair. Over 50% of all money in the Forex market gets traded in the euro versus the US dollar. It's a huge currency pair, and that's the most commonly traded pair, so it moves the most consistent in my opinion. People have other opinions. For me, Euro USD is a great currency pair to start learning at because that's the most commonly traded pair where most of the money in the market is going into. Second pair I'd recommend trading is the US dollar versus the Japanese yen. Um, it's an exotic pair, so it has the Japanese yen in it. But what this is it's a currency pair that it's a little bit more volatile, meaning a little bit more market movement than euro versus the US dollar, but it still gives you the ability to understand like the basics trading with it. So for instance, euro versus US dollar and USD Japanese yen are great currency pairs to get started on learning. Don't even worry about the rest of these pairs when you're starting. Just put these two currency pairs on your phone whenever you get that set up, which you'll learn how to get that set up here in the MetaTrader 4 video. But these two currency pairs are all I recommend looking at whenever you start because it keeps things simple. Then after that you can add a few more, and then after that you can add all 26 currency pairs, and then after that if you want to get into trading like stocks and cryptocurrencies and futures and metals and everything, you can add like 5,000 different pairs to trade. But for when you're starting, keep things very simple. Euro USD and USD JPY are the best to start. This is all your personal decisions, but I just recommend these two when you're starting because it keeps things very simple. So those are currency pairs and the abbreviations. Now, price candlesticks. We're going to be going over these four things right here next to that, but let's just look at these candlesticks. See these candlesticks on the chart? These candlesticks represent what price did within a certain period of time. So the certain period of time is determined by whatever time frame you're looking at, which we're going to go into here in a second. But as far as these candlesticks, this is how they work. So right here we're looking at the euro US dollar. This 60 right here just means it's a 60-minute chart, meaning each candlestick here in the chart is 1 hour worth of price data. So if we're just looking at, let's just say this big blue candlestick right here, we're saying this candlestick right here, price opened, price opens and then it paints the candlestick, and the candle goes up and down as price goes up and down. It represents price as it moves up and down. But whenever price opened up here, it opened up here at this 1.1525 area, and then dropped all the way down here over the course of 1 hour and came all the way down to here, and then was over here near 1.1458 or whatever. So here's how the candlestick works. There's four components to the candlestick, and let's look at that right now. There's the open, the close, the body, and the wick. So we're gonna put these here on the chart. We're gonna write open, and then we're also going to write close. We're going to write body and wick. And I'm also going to break these down a little bit more in later videos so that you get a better understanding. But how a candlestick happens is, remember, it represents price. Whenever the candle opens, it usually opens where the last candlestick closed. So for instance, the price was going here, and then it came down to here, and then here, and then here, and then the next candlestick, which is the one we're looking at, this big blue one, opened. So price opened right there, and then where the candle, like the main part of it, closes, it's right here. And you're going to have to understand what body and wick are. So that's what I'm going to teach you now. So the candlestick body is the big like blue portion right here. It's the portion that's like the bulk of the candle, and the wick is this little tiny little extended part here at the end. So wicks like these right here, see this portion right here? Let me show you. So this is a wick right here. Trading view is going to be kind of weird with like my mouse or whatever, but I just want you to focus on just this little like small little like a pencil line. That's what's called a wick. This down here, this is a wick. Okay, and then, oh my god, trading view. This is a wick. So the portion where it's very skinny and small, that's a wick. And the main portion, which is really the meat of the candle, that is called the body. Okay, so there's the bodies, there's the wicks. So the wicks can be on the top or bottom, just anywhere where you see like these little wicks, like it looks like candle wicks, that's why they call it that. That's the body, or I'm sorry, that's the wick, and then the body of the candlestick is the shaded portion, the bigger portion of the candle. And this is for every single candle. So where the body stops at after the candle has been, after price has been open for an hour and has been painting price or whatever, and it's been going up and down, where the candle closes at it's where this body ends. So for instance, if we're looking at this next candle, and we break things down, we can say the candle opened, since the last candle closed right here, this next candle right here opened right here. So this area is going to be where price opened. Okay, so it's like, it's being weird with me. Okay, but let's just say it opened, right here. And then price during this time went down and up and left wicks here on the bottom, which we're going to go over more. And then price closed up here at the top, before opening this candlestick right here, and it left the body right in the middle. Trading views being so weird. Okay, so the body right in the middle. So that's how they work. It's just the open, the close, the body, and the wick. Those are pretty much the 4 components to candlesticks. And we're going to go over like why price leaves wicks and why price does all this. We're going to go over that all in a separate video about just candlesticks, so that you guys have the full training on what a candlestick is and how to read price. So, but that's what they are. So the candlesticks see in the chart, they represent price, and that's how you analyze what price is doing. So the next component, we're looking at time frames. So time frames, see up here on TradingView, this is how you're going to be using it. Time frames are up here, the 5-minute chart, the 15-minute chart, 30-minute chart. There's all sorts of charts. If you want, like with TradingView, it lets you just like, while you're on the main chart, you can type in any number and it'll take you to a time frame that represents price within that time frame. So for instance, if I type in like 45 here on the chart, it'll give me a chart where each candlestick represents 45 minutes worth of price data. I'm going to take everything off the chart so it's more clean. Usually what we use, like these time frames right here, the 5M, this is the minute 5, the 5-minute chart with the euro versus the US dollar and the minute 5 chart. And this right here means that every single one of these candles is 5 minutes worth of price data. So within the course of 5 minutes for this candle right here, this candle closed right here and the next candle opened right here. So that means this candle was open at around, if we look to the right here, 1.1464 or something like that. And price jumped up here within 5 minutes to 1.1468. That's how you read the time frame. So this is within 5 minutes. However, since this is a 5-minute candle and this is a 5-minute candle, if we were to maybe change the time frame to something like 15-minute, or let's make it even simpler. Let's change it to 10 minutes. If we change it to 10 minutes, essentially these 2 candlesticks are going to combine into one candlestick to show us a representation of what this move would have looked like over the course of 10 minutes. So let's just go to 10-minute right here. And as you can see, the 2 candles got combined into this one candle. And then we can see price sort of was up here and it came down and then shot up. If we go to a higher time frame, like for instance we're on 10-minute right now, if we go to something like 30 or 1 hour, it's going to give us one candlestick that combines all this data. So we're going to go to 1 hour next. That means that would be 60 minutes of price data, right? So since each one of these are 10 minutes, if we go to the 1 hour chart, it's going to combine the last 6 candles of data. 1, 2, 3, 4, 5, 6. All of this price, like this like up and then down and then up movement, is going to be combined into one candlestick. Let's see what it looks like on the 1 hour. As you can see, price went up, then it came down to here, and then it went up again. So see how everything gets combined? And then if we go lower, it's sort of like zooming in. Price went down and then went up. 15-minute, you can see price went up, went down, then went up. And you get to see a better picture of what the market's doing based on the different time frames. The time frames we usually start on are daily. Whenever we get into charting and we like start our actual chart analysis, we're going to be looking at daily chart, the 4-hour chart where each candlestick represents 4 hours worth of price data. And it just really gives you a better idea of what price is doing, starting on the higher time frames and then working your way down to the lower time frames to trade. So that's how time frames work. In the MetaTrader 4 mobile application on your phone, you're also going to learn how to look at time frames on your phone as well, but essentially the same thing as here on this TradingView website that I'm using. So the exchange rate, which is essentially price. See this number right here? Wherever price currently is at, that's the exchange rate. The exchange rate is just a number of what price of the currency is. And if we're saying it in the correct terms, the price of the currency pair, so euro versus the US dollar, this is how we would say it. We would say the exchange rate of the euro versus the US dollar is 1.1468 right now. So this little number right here, you can call it price if you like, but it's just the exchange rate. That's what it is, the exchange rate. So price in points, pips. I'm going to be going over a whole video about this, but just so you know, price in points represents how much movement the market is making. So pips is a way of calculating market movement. For instance, if I were to say, for instance, the euro versus the US dollar moved from here down to here, I would represent this movement in terms of what's called pips. And I would say, for instance, like I said, you're going to learn how to calculate all this in a different video. But for instance, let's just say, I'm going to get this right here. For instance, from here down to here, the market moved 50 pips, 50 price points. And like I said, price points are calculated depending on the currency. But whenever you hear the word pips, just so you're introduced to the word, it just means we're talking about market movement. So pips, it's how you determine market movement. It's how you represent what price is doing. If we were to say price went from here to here, we'd say, oh man, the price jumped up a lot of pips. Let's see how many pips price jumped up. You can ask your friend, hey man, how many pips did Euro USD go up in the last day? You can say, oh, it looks like it went up 127 pips. That's how much Euro USD moved upwards. And like I said, you learn how to calculate that all in the video specifically about pips. Spread. Spread is the distance between the bid and the ask prices of currencies. I don't know if it's going to show it on here. It shows it on your chart if you show the ask price on your chart. But essentially, let's just, an easier way to put it is saying whenever price, let's just say right here, this price right here, 1.153. Since the Forex market, since so many people are trading, so many people are putting in orders, so many people are like literally just that. It's so liquid, it's so volatile because so many people are making trading decisions and entering and exiting trades, and it causes the market to move a lot, and it causes the market to jump up and down. And since the market is so what we call liquid, it's so volatile and it's so active, there's never going to be an exact price. So how brokers get around this, which is what you'll learn more about brokers in the next few videos, or in one of the next videos on brokers. How brokers get around this is by saying, hey, price is, it's about 1.153, but we don't know exactly what price is, so we're going to give you this price on top and this price on bottom, and we know that price is somewhere in between these 2 points, the bid and the ask price, for right now. We don't know exactly what it is, but we know that price is somewhere in between these two areas, and these bid and ask prices will move up and down with each other, and sometimes they'll go a little bit further out, further low. When the market is in a very, very like liquid session with a lot of orders coming into the market, generally you'll see the spread go closer. And here's what you need to know about spread. You want spread, the distance between the bid and the ask prices, you want that to be as small as possible, because when it's as small as possible, you can get a more accurate price. And for instance, whenever you enter a trade, your broker is always going to give you the worst price possible just so they can be safe. Meaning if they say like, hey, price is it's 1.153, it's something in there. We don't know exactly what it is because the market's moving so quickly, but it's somewhere in 1.153. So they may quote you as saying, okay, this higher price we're going to give you is 1.1532, and the lower price we'll give you is 1.1528. So there's this distance between these two, and the real price is somewhere in here. Nobody knows what it is since the market's moving so quickly, but they know, hey, we've pinpointed prices somewhere in here. If you're going to buy, we're going to give you the worst price, which is 1.1532, and if you sell, we're going to give you the worst price, which is 1.1528. And so whenever you open your trades, they're going to give you that worst price if you're buying, and they're going to give you the worst price if you're selling, just so they can be safe, since they don't know. And like I said, whenever the market gets really volatile and a lot more people are trading, this distance gets smaller and smaller and smaller because brokers can get more of an accurate price. So all you need to know about spread is these two bars that you see on your chart, the bid and the ask price, you just want those as close as possible. And it's going to be showing, like right here, for instance, this is the bid price. If I were to show the ask price on here, which, let me see if I can figure it out real quick. Price line, trade. See if I can pull it up here real quick. I can't find it. I have to find it and put it on here. But essentially, all it would do if I put in the settings to show the ask price, this little price right here you're seeing 1.1468. That's just the bid price. The ask price is going to be something like that as well. So typically, like if you're looking at it on your phone, or if you vote to show the ask price, you're going to see two price bars. One of them is the bidding price, one of them is the asking price. So it would look something like this. You would see like that current price that I told you, 1.1468, and you would see another line as well, and you know price is somewhere in between that area. So both of those lines, the bid and the ask price, both of them have to move past your target area for you to close your trade in profit, and both of those bars have to move past your target area if you're selling for your trade to close in profit. So that's it, bid and the ask price. You just want the spread, the distance between the bid and the ask price, you just want that to be as small as possible. So that's why if you trade pairs like Euro USD and Euro USD Japanese Yen, which have a lot of liquidity, which have a lot of people trading those pairs because they're very common, you get better spreads and you get better bid and ask prices, a closer distance between those two. So you don't have to worry so much about, like, you know, having a big spread, which can screw with your targets and stuff like that. So that's what spread is. Make sure that the spread is very, very tiny whenever you're trading. Trends. Up, down, and flat. So let's just, in a very simple way, like I said, we're going to be learning a lot about what's called market structure and the way the market moves and the different movements and patterns it makes. But trends, essentially, they're really easy to understand. If you see the market going up, like if you just zoom out and you can look at this and I ask you, hey, do you think the market right now, just looking at this screen right here, Euro USD on the 60-minute chart, is it going up, down, or sideways? That's the three questions you ask, up, down, or sideways. This we can tell, most people would say it's going up. I would say it's going up. A lot of people would say it's going up. So we can see that the current trend right now, Euro USD, it's trending upwards. Okay. If I if I show you just this data right here, just this, and I ask you, hey, Euro USD in the 60-minute chart from December 18th to December 31st or whatever, December 27th to December 31st, what is the market doing right in here? You could say, the market's not going up, and it's not really going down. It's kind of going sideways. So we call this flat. The market's flat. And you can also, you can also call this, you can also call this whenever the market's flat and just going sideways, you can also call that a range. So I'm going to put this in here. This might be something you want to put in your notes as well. Trends up, down, flat. And flat is the same thing as saying range. Whenever like somebody asks you, hey man, what's your USD doing right now, and it's just going sideways, you can say, oh hey man, it's ranging, price is ranging, price is going sideways, price is flat, price is not in a trend, it's not in an up or down trend, it's just going sideways. So that's that. So make sure you write that down in your notes. All of this stuff I've just sort of like put the basics in here so that you have something to write down, or if you're taking notes on your computer or phone, like this is just all the basics and you can like put all your notes off to the side. But up, down, and flat and ranging. So we've seen the uptrend, we've seen the flat market, the little ranging market, the sideways market, and the other portion is a downtrend. So if we just look and just find a downtrend, if I just ask you, okay, just based on this chart alone right here, what was the market doing? You could kind of say it was going sideways, but this looks more to me slightly discretionary. This is slightly discretionary. It looks like the market's going downwards through here. And then as it was going downwards, and it ended up stopped going downwards, and then it ended up breaking out and going upwards for a while. And then this trend was created right here. So we have this uptrend, and then the market started going down for a while. So we have this downtrend, and then the market started going up for a while. So we have an uptrend. So see, the market just goes back and forth. It just goes up and down and up and down. But essentially, you're just looking for trends, downtrends and uptrends. And this is discretionary. Like if you're looking like just right in here at this price data, the market's going sideways right here for this period of time. But if you zoom out and you look at the bigger picture, you can see, okay, the market's going upwards right here. So that in this case, the market's trending upwards. And then it got out of that uptrend and then started going down for a while. Then it got out of that downtrend and went up for a while. So trends. There's just three trends. There's an uptrend, there's a downtrend, and there's a sideways market, or range. Range is usually how most people say it. So that's the types of trends, up, down, and then no trend at all. So price levels. Price levels, we're going to be going into a lot of detail about this because this is one of the fundamental aspects of trading. But price levels are essentially the areas that price interact with on the chart. For instance, if I have this little box right here that I'm going to draw, I'm going to put this on the chart, and I say, Euro USD, every time it gets up to this area right here, this 1.146 area, it's kind of paused in the past. It's kind of like bounced off it and it goes down. And so if I represent this area and just highlight it here on the chart by this shaded box, which you learn how to use TradingView here in a bit, but by this shaded box, I can say, at this quote unquote level, price tends to interact with it. Price tends to bounce off of it. Price tries to get above and then gets below it. And then it bounces again. And then price got above this level and now it's come back to this level and it's pausing again. Whenever you see these little sideways areas in your chart, we just call those levels, okay? You can draw them anywhere you see price interaction. For instance, down here, we see a lot of price interaction down here. For some reason, every time price comes down in this area, we see price bounce a little bit. And what you do, how you use levels is you use them to help you make trading decisions and to predict where price might possibly go. The idea behind levels is that last time price was at 1.146, price reversed, and then price got here again and then reversed, and then it got here again and then reversed, and then it got here again and it started to reverse. And so yeah, that's levels. It's just looking at horizontal areas on the chart and making a decision to say, price looks like it's pausing at that area a lot. That's a level that price is interacting with. This would be another level as well. And you can do these. It has to be really obvious. If it's not really obvious, then I wouldn't really call it a level, and I wouldn't really give it much attention. But you're going to learn all how to draw these levels in the future videos. So that's what levels are. So price levels. So buy and sell, long position, short position. There's two types of trades you can make whenever you're trading the Forex market. The first type of trade is a buy order, and the second type of trade is a sell order. So just like I went over initially, whenever you buy the market, you buy with the anticipation that it's going to go up. So if I were to buy the market right here, I would use this little tool on TradingView called a long position. And it just means that whenever you buy, you want the market to go up, and if it goes against you, you're going to lose money if you close the trade at a loss. So that's what a buy position looks like. This green area is just price. It's showing like our target. So like 90 price points of movement, we would hit a target, and that would be cool. If price went up, we could make money. This little red area, your stop, it shows where if price goes, it's going to hit that area, and it's going to show you how much money you lose based on where you put your stop loss at. So this is the long position. Whenever people say long, like, oh yeah, I want to enter a long on Euro USD, or hey, I'm going to go long on Euro USD, or hey man, we're going to be going long on EU today, man, you're going to go long. People are just saying they're going to buy Euro USD. So that's what that means. The second type of position is a short position. Short position is just saying, hey, I'm going to enter a sell. I'm going to click sell. I'm going to enter a sell. I'm going to sell the market. So whenever someone says, yo man, you're going to be selling Euro USD today, you can say, yeah man, I'm going to sell Euro USD. I'm going to go short. I'm going to go short on the market. That's what it's called. Enter a short position. So a short position means you're going to enter a trade at a price with the anticipation that you think price is going to go down and your profit target is going to be at a lower price. And if price goes down and you successfully predict that price is going to go down and it goes all the way to your profit target, then you're going to make money. But if price goes up against your short position, against your sell position, then you're going to lose money. And this is all going to be predetermined before you ever enter the trade. After you learn how to mark up the charts and do analysis and stuff like that, all this stuff like your stop loss areas and take profit areas, all that's going to be predetermined before you even do the trade. So that's the two types of positions: a buy position and a sell position, or long position and short position. You're going to go long or you're going to go short. Those are the only two types of trades. So the next and last part is broker. So broker, whenever you're trading Forex, since we can't go to the exchange counter and get like $300,000 worth of currency, hold on to it while the exchange rate changes and then change it back to the base currency, which is what Forex is. This is just pretty much you're taking a base currency, holding on to it, and then converting it after the exchange rate changes back to the original currency that you got in at. And so in short, like an easier way of putting this is just say your broker is the intermediary. It's the middleman that connects you to the financial market. So this right here, this is just a price, right? And price, it's all done on what's called the intermarket with Forex, and it's an international market. And throughout the intermarket, this is just the price that that this exchange rate of this currency is. And so you do this, you execute trades, and you make money or lose money by using what's called a broker. So there's a bunch of different brokers. We're going to go over this in later videos. I just want to introduce you to the concept here. But you're going to be using a broker to place trades in the Forex market. That's the only way to do it if you can trade it online, unless you physically go and like get the currency, hold on to it while the price goes up or down, and then go and turn the money back in and convert it back to your local currency. If you did that though, you'd have to have a ton of capital and you'd have to have a ton of time to be going and doing that all the time. With Forex, you can enter trades literally just at the click of a button using your brokerage, and a broker just executes the trades for you. It connects you to the intermarket of Forex so that you can actually have your money into the market and then pull your money out of the market. So that's what brokers do. So that's all I got for you guys here in this video. This is just the basics and introduction. In the next two videos, you can learn how to use these platforms like here at TradingView. You guys may have already picked on it a little bit since I've just kind of been using this as I've been teaching you what's going on. But you're going to learn how to use the MetaTrader 4 app and all the different features of it. And you're also going to learn here on TradingView as well. So I'll see you guys in the next video. This was Nick with Mission FX. Thank you for watching.